Live streaming is on. Streaming is on.
Welcome back, everybody, to our trader strategy meeting. As most of you know, we do this every month or so, and we try to break down some of the key themes that we're going to be seeing over the course of the month. Of course, we are in some of the doldrums of our trading season. Of course, we just saw earnings season pass. We had the Fed pass last week, and we have a few things on the horizon. However, we are in the middle of August, so we shall see what these traders have up their sleeve. As usual, we're going to kick things off with Chart Trader, talk a little macro perspective. So I'm going to welcome in Brett Manning. Chart Trader, how are you, sir?
I'm doing pretty good, Jim. How are you?
I'm doing all right. Well, I'll tell you what, Brett, we had a brand new data point to consider today, and that was cooler than expected CPI. Now, the core CPI came in underneath expectations. Is this the beginning of a trend or a one-off?
I'm not sure about that, but I think that it's interesting to look at its effects. So the important thing is we saw a 4-month low in the core CPI month over month, even though the headline year over year was basically tied for the highest since like 2008 or something. So I think people are looking at the core 4-month low as the important point. But the interesting thing to note is, TLT is down on this. Rates are up on this. So I think what that tells you, I think that says something really important. I think what it says is that the market sees policy is the big key right now, and the bond market's actually going to see pressure if the Fed is less motivated to step in and start to tighten. And what that tells you, I think, is that the market sees reactive tightening in reaction to the type of inflation that we're seeing now as being potentially a policy error. The way that I would reason that is the nature of the inflationary pressure that we're seeing right now is something that tighter policy doesn't necessarily target very well, because it's about supply hiccups in goods and services and labor. So really, if you have the Fed willing to, if the Fed feels less pressure to do something like really talk a lot about tapering because people are worried that inflation is getting away from them right now. If the Fed's not in that position, then they can stay back, stay just as accommodative, and actually that's going to be what steepens the yield curve. And I think that that's what we're seeing at this point, is this just contributes to the ability of the curve to steepen, the long end to rise, because we're not going to get the Fed coming in and trying to shut things down.
So does that put this Jackson Hole meeting kind of less relevant then, because it was something that we talked about in prior strategy meetings as a potential big event, but it sounds like they're able to push this off, so the Jackson Hole meeting may not have the same relevance that we might have thought at once before, right?
Yeah, it seems it depends on where they really want to be. If they really didn't want to have to start, getting really concrete about a taper timeline right now, then this allows them to do, to do what they really were hoping to do anyways. And I guess it's possible that, they were really looking for an excuse the other direction and they may still address it. But I think the combination of, Delta plus this, I mean, this really is, a shift in the inflation narrative. Now, the Fed always says, and rightly so, one data point does not a trend make. And it's possible this is a one-off and they're looking at some rolling average and they stay disciplined to that approach. And this really doesn't change that much. But I would think I got the feeling that, some of these high numbers, certainly Powell and really the core leadership of the Fed, they don't believe that the type of inflation that we're seeing now is necessarily something they should be reacting to. If it changes inflationary expectations over time, that changes that picture. But what we're seeing right now is not an example of too much stimulus in the system. It's an example of supply chains and the supply of labor being impacted by the reopening process and by the pandemic. And that's what's causing the change in prices, rather than that the Fed has been too accommodative for too long. So I feel like they don't want to have to be forced into reactive tightening. So I think probably this makes Jackson Hole certainly something that people are going to be maybe less hedged around.
All right. Well, with all that said, you threw on a couple of short trades. A NASDAQ trade earlier today worked out very well for everybody. And then you threw on a mini Dow short. So why don't you walk us through what you were thinking? How much did the data that we saw earlier today play into that, and just the overall trade structure, if you will?
Well, so I mean, obviously, I got rid of the YMs pretty quick. I was looking
Did
for
you? I did
something.
miss that one.
Oh yeah,
I
yeah.
missed that
No,
one.
I ditched it. It took a look for me. Got about 26 in the money. We saw a bid come in. We saw it try to take another look. Another bid came in right along that level. It's the leader, so the setup, in my opinion, is something I'm not going to stay with at that point. And that's how I generally deal with things. If it gives me a couple shots at what I was looking to see it do, and it doesn't react right, I'm pretty quick to throw things out. As far as the NQ setup, it was somebody asked the feedback, like what I was seeing, and it's a couple of things, but really at the end of the day, just the nature of the order flow I was seeing and the fact the NQs were lagging, and we're seeing this rotation dynamic, YM's breaking out, NQs, the bid comes in, and I get this feeling when I watch certain types of orders come through where I see there's an offer that's just more real, and what's on the bid is probably a lot of loose money just looking for the NQs to play catch up because the stock market is breaking out, and these are all the favorite stocks, and you see that kind of bid come in, it's bound to lose. And I also follow the IWD IWF ratio. I incorrectly posted this earlier as IWD IWO, but I watched the IWD IWF. I was talking to a friend who said it the other way, and it just was in my head when I typed it up. But IWD IWF is a good ratio chart to watch. I also watched the YM and Q ratio chart, and in this environment, I just look at that ratio chart, and the ratio chart for IWD IWF looks like a buy, and to me that's a signal to short the Qs, generally speaking. So that lined up, and just the feeling that I saw from the order flow, stiff offer, loose money on the bid, and mostly just kind of a well-informed, long-cultivated gut feeling. And it worked really nicely for us, and it's still on small, and we'll see if it turns into something bigger. This is the kind of stage of position managing where I usually like to really let something try to run a long ways, or I let it come all the way back on me. And I've learned that can really pay off. So I'm basically in that situation now. We've broken an important trend line. If you look at the NQ's daily chart, going back to mid-May, the secondary low in mid-May, touches the trend again in July, and kind of brushes up the end of July a bit. But that trend line is now, we're on the underside of it. So that's an important shift. And with this rotation dynamic in play now with the YMs, I was looking for this to become more broad-based to the downside. It didn't happen, or at least not yet. It could still happen. But yeah, that's what I was thinking for the NQs.
All right, Brett. Well, I will say that as far as days go now, I've been off for a couple of days. However, the trading activity among the group is pretty decent today. I know Scalp Trader, you were on vacation last week, but you jumped in with a few names here today. So why don't you break down what you've been looking at lately? I know things have been quiet for you, Scalp, but you have dabbled a little bit today. So have these stocks fit the criteria of what you've been patiently waiting for?
Yeah, so getting back into the swing of things after being away on vacation for a week, which was nice to finally get away after being locked down for over a year. First trip, and since then. But yeah, so right now, and I'm really focused on intraday opportunities, looking at trading ranges, stocks that are like, so today, long ENVX and what is the other one? BFLY, just playing pullbacks after recent sharp moves higher in price, looking for a short-term bounce. And both of these names kind of look interesting as potential swings as well. So I have to decide if I want to hold on to them as swings. And the ENVX in particular, I like possibly a little bit longer term. But, again, I'm just really just trying to maintain patience. And I'm looking at what some of the other guys are doing. I mean, I think one of the benefits of the service is that we always have different strategies going. And so there's always something happening. And so when one style is out of favor, usually there's at least two other traders who are generating high quality ideas, possibly three, possibly four. I think my general, longer term style is out of favor because I like distressed, I like value, I like relative value. I like those big trades. So, that one trade that can make your year, or two trades that can make your year. Everything's so elevated right now. It's just there, I mean, I don't recall a time really since probably 2000 that when I look across asset classes and think that literally everything is just massively overvalued. Like, I don't recall thinking that since 2000. So that's just something for me to recognize and to make sure that I'm not overexposed to when when that pullback eventually comes, that shakeout eventually comes. So I'm content just to be patient and just wait for compelling opportunity.
Well, I'll tell you what, Scalp, every time somebody brings up 2000, everyone's going to start thinking, hey, you must be thinking that things are overvalued and we got a big correction coming. So I know you aren't necessarily looking for shorts, but I think you got to throw that on the radar, at least identifying a correction. What do you think are the classes that are, let's take, big tech off the table, because we've got plenty of guys who will be focusing on that. What are some of the other vulnerable asset classes that you see?
Yeah, I mean, I think they're all vulnerable. I mean, everything looks overvalued to me, and I mean, tech in particular. So one of the things I like to look for is just looking at earnings of tech companies and looking to play breakouts and kind of that next big tech name that breaks out to new highs post earnings. But when I look at the valuations of these names, I'm just thinking, wow, like a market pullback could, just a general pullback, could clip these things 40 to 60%. And if a company misses a quarter, I mean, you could basically have essentially a stock that's going down for the next 4 or 5 years because you're unwinding a multiple and a name that is no longer seen as a growth name that's trading at 25, 30 times revenue. So it doesn't get me excited. I think Craig has a really good feel. Trend Tracker has a really good feel for these types of names. So I lean on him for, I'll always look at his ideas to kind of see what he's highlighting, and I will play some of those, and even names that he's talking about as being possibly overvalued, I'll take note of what he's saying, so that when maybe a company does get hit, I don't know, maybe it's just general market pullback or something of that nature. Maybe that's an opportunity to start to participate in some of those types of names. But yeah, I don't get excited about a lot, and the idea of trying to make 5 or 10% on something doesn't excite me. But I know that once you kind of get that shakeout, that's where you get the opportunities. Things can come unglued and unwind 30, 40, 50% really quickly, and only takes like an earnings report or price momentum or a news item to quickly ramp something back up 75%, 100%, where it essentially recovers everything that it lost because it has some type of catalyst. And so one of the areas I'm looking at, continue to look at, are the SPACs. A lot of these SPACs are reporting bad numbers on the initial report, and the stocks are just getting hammered. And so the idea of being able to buy something, something that SPAC conversion at $10 is now trading at $3.50 or $4, like the ATIP that we bought. I think we started buying it 2 weeks ago with the average price of 3 something. Been selling it this week for 25, 30%. A name that I think has potential, compelling long-term upside. You're seeing more and more SPACs disappoint on their first quarter, and so I sift through those every day, and I might not write about them, but I recognize them and spend time looking at them, evaluating them, and maybe I'll come back to some of those further down the road. Maybe if they fall another 20, 30, 40%, I might throw it in the portfolio.
All right. Are there any other SPAC names that you've been eyeballing?
So I looked at this SFT earnings report today. Stock's down. A lot of the SPACs are down today. This is kind of like a Carvana play. They had a pretty good earnings report. So it's one that's on my radar. I think it's one that if it starts to show signs of a technical breakout, it could really get going. But right now it's kind of been trapped in a price range, and the reaction to the earnings report is not not compelling at all. The fact that it's under pressure here, but it's one that I'll keep on my radar. This ENVX, the battery play, it's been pulling back. I think it's a pretty interesting name. We see the VACQ, which is Rocket Labs. It's starting to tick back up here. I like this one a lot long term. And we've been scaling into that one starting around 11 or so, all the way down into the mid 10s, about 1090 right now. But that's one I think is really interesting long term. I think it's one of the more interesting space SPACs and just SPACs in general.
And that first one you mentioned was SFT, Shift Technologies, right?
Exactly. Yeah.
Okay. All right. Yeah, I just wanted to make sure that everyone knew what that was and make sure I had the correct chart up. So, all right, Scalp, why don't we jump to Trend Tracker? Now, Craig, Damon kind of put you on the spot talking about valuations, and I know that you were talking a little bit about Moderna this morning, that the party might be over there. You're long NVAX. So you got a little Moderna NVAX pure pair trade going on there?
No, I kind of missed that one. I was talking about the pairs trade 2 or 3 weeks ago, I think. So I was a little early. I did have a short attempt on Moderna a week or so ago. And obviously yesterday and the day before was the time when that parabolic move kind of ran out. I've been, the valuation hasn't made sense for the last couple of weeks, so I knew it was just a matter of time, but obviously timing is everything when it comes to something like this. I thought that the stock was overvalued back in the 200s, incorrectly a month ago. And then I was thinking most recently, the surge on, was that Monday, looked like it could have been the end of the line. And of course, retrospect it was. But I was thinking that, when we get the official announcement on boosters, that would maybe be a sell the news. So I do think this can maybe come back, just technically now it's kind of blown through the support it had from like last week. And there's a lot of support there around 350. So it looks like it could be headed there. It seems like in the coming weeks, the U.S. is going to make it official that boosters will be an option for at least the vulnerable frontline workers, or frontline workers, elderly people, what have you. I'm assuming anyone who wants one will have the option coming this fall, this winter. So of course that's a big boon for all of the vaccine companies. It's good for NVAX too, because it's just going to be more demand for vaccines. NVAX has really kind of said that it's going to be targeting the developing world where it's needed. So I continue to like NVAX. I missed the ideal short entry here on Moderna, but if you look at the valuation now, it's valued at Moderna is valued at as much as Merck, or it was valued close to as much as like Merck, more than Amgen. It really just didn't make a whole lot of sense. I realized that the mRNA platform has massive potential for the long term, and yes, they are printing money from their COVID vaccine for now, but at some point the market is going to be looking for the next drug, because these vaccines can sustain some good numbers here in the coming years, likely, but at some point, the market is going to be wondering where the next leg of growth is, and it's going to take years. Obviously, the only reason that they've executed flawlessly, but only in a pandemic is the government willing to give this emergency use, which got this vaccine across the finish line in a year, when normally it's more like 10 years. So, at some point, the question is what comes next. So with this parabolic move, it was just kind of a matter of time before the stock would top out. I continue to like NVAX, trading at a fraction of the valuation. Of course, it doesn't have that amazing long-term bull case, because it's not next generation technology that can really revolutionize medicine that mRNA has the potential to do. It's just your average vaccine maker. But as I've been writing all summer, it is going to be the preferred vaccine for much of the country, or for much of the world, potentially even the preferred booster. But the reason that it's very efficacious, it's safe, not experimental in the way that mRNA is, and the supply chain is a lot less complicated. So it's really just going to make it a lot easier to get it across. I'm having trouble hearing you. The finish line. Sorry about that. It's just gonna make it a lot easier for the rest of the world outside of the rich Western countries that have already been vaccinated. So I continue to think we could see new highs in NVAX. I wish I was a little bit more aggressive with it, but I did get a good ad last week in the 190s. This thing's going to remain volatile, but for now, it's I think a buy based on that It's what is still speculation, but what at this point is very likely a series of positive catalysts in terms of approvals and filings. So I continue to like it a lot.
I'm curious. I am curious about one thing. So, considering that Moderna and Pfizer are basically very similar in their technology as far as the vaccine goes, are you able to get a booster from a traditional vaccine like NVAX or J&J? I haven't followed it that closely, but I assume you have. So for instance, I got the Moderna vaccine, right? So do I have to stick with a Moderna vaccine throughout the course of history, or at some point has my body adjusted to it and then I can get an NVAX or J&J vaccine? How does that work?
No, that's a good question. And from the data that I've seen, it might actually be beneficial to get a different one. Again, I'm not a scientist, but my impression is that's part of the reason why NVAX could be so coveted now, because the differentiation in a way is a positive. And perhaps most importantly, the NVAX safety doesn't have the mild safety issues. Everyone who has gotten a Moderna or the Pfizer vaccine, some people were fine. Some people got a little sick for a day or so. And of course, it is a reason for the people that haven't gotten vaccinated to be weary of some experimental thing that was rushed through, right? But to answer your question, I think it's actually advantageous. A lot of the people that I follow are saying, they would prefer to have the NVAX booster. I'm not sure if we will have that option, but it's important to keep in mind that I think the first jabs went out in this country in December. So the nurses and the people in nursing homes and all the most vulnerable, they're pretty much due now. So that's why, that's going to happen soon. I'm assuming that the government is going to say, okay, boosters are on the table now. I didn't get mine until I think it was more March or April. So, at 6 months, you're still protected from the severe disease, but that's when your protection starts to wane a bit. So you can make the case that in the 6 to 12 month time frame is when you would want a booster. I'm assuming a lot of the people that got vaccines are going to opt for boosters as well, but they're definitely due for the most vulnerable. So yeah, I think that's going to happen soon, and perhaps NVAX will be an option in the U.S. But it seems like, actually, I'm sorry, they're not going to apply to the FDA until Q4. So the potential for NVAX boosters in the U.S. may not be a reality until maybe December, January. So even though that would be nice, that's why the stock fell 20-30% on Friday, because it was yet another delay. It definitely seemed overdone, and I could understand why people are like, the skeptics were proven right once again because it's yet another delay. But they really had already filed in India, Philippines, Indonesia. They're going to file to the World Health Organization. They're going to file in the EU and the UK, followed by the FDA. So, of course, the market is going to shoot first, ask questions later, and put max pain on people who were weary to puke on Friday. But I did view that as a buying opportunity, and so far that's mostly played out. And I had mentioned this, I think, a few weeks ago, how I think the two stocks that I've been talking about the most this summer have been NVAX and Upstart, and those are both starting to pay off this week. Obviously, Upstart reported last night, and NVAX has bounced back after that minor delay from last week. So there is a correlation between, if I become somewhat obsessed and I'm like talking about a stock every day, that usually indicates that obsession imbues some conviction, I suppose you could say.
All right, so those are the two stocks that you have been talking about this summer. Now going into the fall, what was he going to be talking about? That's what everyone wants to know.
Good question.
Well, throw out a couple. If they don't play out, then and you don't have the conviction come October, well, then we know that they didn't play out the way you did. And the fact that you scale into things, we have some time. We know that your holding period is going to be a long time. So at least throw out some names that people can do some homework on.
Sure. So a stock that I am I am liking here. I had some good trades on it this summer. This PLX Pharma, PLXP, had some constructive, is undergoing some constructive consolidation, I guess you could say right now. It's at a close to a 1 month low here, coming in on its 50-day. This is another pharma that got a generic liquid, the first ever liquid aspirin approved. They already have distribution to all the big pharmacies in the country. So the expectations are high for this launch that starts this month. So, the stock has been under heavy accumulation in recent weeks and months based on this recent approval. And then I think there was news that Walmart was going to carry them, and it gapped up and pulled back, and that's when I got in. So I had a couple nice trades. I scaled out of most of it. I have a small position left. I'm tempted to add here. I'm not sure if it's going to come back into this 50-day, another point or two lower, but I think this stock still makes a lot of sense. If you look at next year, it's maybe trading at like close to 20 times next year's sales, which are obviously at zero right now, but this could be like a game changer in terms of the cardiovascular market, people that need to take aspirin on a daily basis. So that's one that I'm stalking here potentially. I am down to a small position, so I am thinking about adding here. So that's one. And,
all right, so PLPX, one of those. All right.
I'm sorry, PLXP.
No, that was my fault. PLXP. It's correct on the chart right now. PLXP, yes.
And I mean, I know everybody knows I like Coursera, which I added yesterday. It's up a little over a point from where I added yesterday. I really like this one long term. We got a nice gap up, strong reaction to the very strong print, a lot stronger than I was expecting. The narrative is sort of shifting from a pandemic play to just a play on people needing to skill up for the good jobs that are out there and for like the future jobs that everybody wants. So this secular growth story is really compelling in my view, but as we see sometimes with these recent IPOs, the narrative can take some time. I'm sure you remember with TTD. Now, I'm not saying this is going to go up 10 times, and I don't want to get expectations too high, but I was long TTD for a while, pounding the table until the street or everyone really realized how special the company was. This company kind of came public at a time when growth stocks were hated. So that first Q1 report was great, and the market didn't care at all. Market fell to new low, or the stock fell to new lows. Consolidated for 3 months. They reported an even better quarter that really kind of showed that it's not just a pandemic play, but more a play for people just trying to reskill and get good jobs. I mean, it's a very strong story in my view. And the market and the stock gapped up, and now it's kind of given almost all of that up. So, they're going to have to keep beating and raising to really establish themselves as one of those premium software growth companies or stocks. So right now it's trading at like 9 or 10 times forward sales. I think you can easily make the case, if they can keep reporting quarters like Q2, like they did last week, you can easily make the case that this is worth 20 times sales when we have a lot of companies that are trading at 30, 40, 50 times sales at this point. So, the potential for multiple expansion is certainly there. And the management is strong, guidance. The CEO previously sold one of the, he was I can't remember it might have been Exact Target. He was a CEO and ended up selling. So I'm not implying that he's going to sell to anybody. This company is probably going to remain independent, but the CEO knows what he's doing. So if that beat and raise story can continue, then I think the stock is very much undervalued here. I think it's $5 billion, and I do think it can go multiples of that. Again, I don't want to get expectations too high, but this is the sweet spot. Are these recent IPOs very strong companies with big secular tailwinds, trading at more reasonable valuations? Small mid caps where $2 to $10 billion companies can become 10 to 20 to 30 plus billion-dollar companies. That's where I've had my most success. So Corsair is definitely one that I like owning here for sure.
All right, good stuff. I appreciate you giving us a little heads up as to what you're going to be working on now and into the fall, so that's good. Now, a man who you guys hear from quite frequently is our man, Scott. How are you today, my friend?
I'm doing okay.
Yeah,
I've had better days.
Don't be so enthused, my friend. I haven't talked to you in a long time, man. It's like you I don't know, maybe
I'm still
Scott,
alive.
yeah. Well, I know
Kicking.
I will hear you. I'll hear you in the afternoons, but we don't get to talk as much. So anyway, you have been pretty busy, I think, today, and you even threw out a short there. So walk us through that one. I know you talked a little bit about it yesterday,
Mm.
and it was what was that stock that you just shorted? FDN.
And it's the
Yeah.
internet ETF.
Yeah, so I'm not all that particularly familiar with it. So you must find that some of this big tech is a little bit vulnerable. So
Mhm.
with that said, walk us through this and maybe some of the other sectors that you're seeing some vulnerability.
Yeah, I mean, to keep things really short, if I had to sum up what I'm about to talk about in 2 words, it is sector rotation. And I feel like I'm beating a dead horse how many times I say that on Trader Audio the last few weeks every afternoon. The sector rotation is so strong in this market here this summer. And I think from a short-term trading perspective, you just have to follow those flows in and out of different industries. Now, of course, some of those are earnings related. You're definitely seeing gaps and money flowing out of groups based upon their earnings reactions. But some of them are also just technically based, broader macro based. Some of them are, just defensive positioning, seasonal based. But the key thing that I think we've been, actively trading here for the last few weeks is really just kind of identifying money flowing into various groups and just kind of jumping on board them and holding them on for a few days. We've actually captured a lot of nice little swing trades, holding names like, and a lot of the ETFs, I've been trading a lot of the ETFs more so lately because the groups are so strong. I'm not going to run through all of them, but I mean, it's just been plentiful. And I just think the key thing that we have to recognize in the current environment that we're in is rotation is extremely strong in this market. And going back to how the FDN short technology, up until like 2 days ago, was a leading group. The semiconductors were pushing at their highs. Excuse me. Software names were also pushing at their highs. And then we start to see a little bit of that momentum wane into the end of last week. And then you started to see the XLK be one of the first ETFs, the technology ETF, undercutting some of last week's lows yesterday. And while that was going on, there was definitely money rotating into groups like basic materials. Financials have been really strong lately, obviously, after the employment data last Friday with yields rallying. Financials have been getting a boost. We've seen blockchain and various cryptocurrencies capturing some bids here throughout August. This rare earth ETF, REMX, has been super strong here the last few weeks. We've seen that race into the upside along with some lithium sort of alternative battery plays going on there. Infrastructure plays. I mean, of course, that's making all the headlines. And for the first time in about 5-6 weeks, we actually have the XLI, the industrial ETF, breaking out back over that 103, 104 resistance area, right where it's been struggling for about a month and a half or so around that 50-day moving average. So we're starting to see money flowing back into that, not just construction like Caterpillar and Deere, as well as like Illinois Toolworks and Honeywell, et cetera. But we're also seeing money flowing back into the transports here as of late. IYT is just starting to recover, trading above prior week's highs here today. We're starting to see a boost back in the railroad stocks, back in truckers, back in airlines. I did take a swing long in UPS this morning. UPS has been basically stabilizing around that 190 support level, which goes all the way back to an earnings gap from April, a bullish earnings gap in April that's been holding in there. I'm not sure which way it's going to go, but if you look at FedEx has been under pressure here the last 2 weeks, and it's finally starting to bounce as well. And like I said, the IYT has been attracting some bids here the last 2 days. So I figure this little tight consolidation in UPS might give us a little bit of an upside bounce for a few points before the potential of it breaking lower. Housing has been attracting some bids lately in the discretionary area. ITB, XHB. In addition to housing, retail names, we've seen some apparel names really just start moving to the upside there. Gavin, event trader, he's been talking about Ross Stores as one of his picks, ROST, as a back to school play, along with watching TJX. And we saw both of these names really strong performance yesterday. TJX actually broke out above that 69 resistance area to a fresh 2-month high. Walmart, a name I've been long for about 3 weeks, also trading up and breaking out to new highs there. Target has been the leader in that group as well. Costco has been really strong. So it's really kind of, I could keep going on and on here. I could run through biotechs and how staples and utilities are making new highs. It just, at the same time, there's other areas like gold that are just really struggling, and energy that's really just been not doing a whole lot lately. Anything China related, obviously, with all its political issues, is not doing anything well also. And I think that just, again, I'm going to go back to how I started here. It's all about sector rotation. If you're trading here during the summer, it's about just paying attention to relative strength, relative weakness in various industries, looking at the charts and going with the flow, and not necessarily trying to consistently fade these rotations that are developing. Now, when they start to roll over a little bit, like we've seen here in the SMH and the XLK, and again, the FDN, which is, looking quite precarious the last week or so around that 50-day moving average, those are viable laggards that I think you can jump on board shorts a little bit, feel a bit more confident behind them, because it seems like they are waning a little bit, and they are starting to see some money rotate out of them as everything else goes into various groups. So that's really where I stand. Going forward, obviously earnings season is going to be dying down here in the next week or so. And then we get that late August timeframe into Labor Day weekend in September, which is usually like the dog days of the summer, where anything goes. You can get a corrective move. You can just basically flatline in the market and do absolutely nothing, as everyone just kind of maintains the status quo. And then September seasonally is, up there with one of the worst performing months of the year. So there is, some prudence behind easing off the accelerator a little bit, perhaps, focusing a little bit more on protecting your portfolio on a short-term basis, maybe selling some covered calls on some swing positions, maybe hedging, like we said, shorting some ETFs against, various holdings that you might have. We don't have a crystal ball. We can't predict this stuff, but you can kind of just feel like that, that if the rotation dies out soon, and we start to see further downside distribution days, especially below weekly support levels, and 50-day moving averages, it's going to raise a red flag that, there might be a little bit more of an aggressive correction to come. Not saying that's going to happen, but it's something that we have to be aware of and just keep on the radar. But until that happens and I start seeing those signs, I'm just going to continue to stick with these short-term, swing trades that have really just been doing well for us on that rotational basis.
All right, Blue Chip. Appreciate the insight there. Brett Manning, I'm going to bring you in for one more question here. And considering we're in the midst of August and the trading volumes are lower, European traders are basically on vacation for the month, whatnot. So, how do you navigate through a thin market, these summer doldrums? Now that we've got earnings season almost over, without a whole lot of catalysts out there, what are some tips that you have for our listeners to navigate through this type of market condition?
So, well, I think the big point here is it's not just thin. It's that I suspect, now I don't know for sure, but I suspect that we are moving into a political headline minefield at the same time. And it's really that combination that I want to kind of proactively warn people about in terms of what it can do to your trading if we start to get. So I mean, anytime a market is extremely preoccupied with like one specific headline theme, like Brexit or Grexit or the debt ceiling or the infrastructure bill or whatever, it's going to be impossible to position in anything that's large cap or macro with real conviction, because you know that everything can completely change 5 minutes from now on the next headline, especially if they're happening multiple times a day and people get used to that kind of thing. So that's why I call it a headline minefield. You're just walking along through a field and everything is going just fine, and then boom, everything changes, and completely without warning. Nobody could have warning for that. It just happens. And 5 minutes later, you start to find out why, because the headlines cross the wires, and you realize it's a complete sudden state change, and it can happen at any moment. And I think we're starting to work our way into that with the infrastructure bill and debt ceiling. I think they're going to be more and more important to the market, and also we're heading into a world where people in Congress are starting to move toward true campaign season for next year's midterm. So they're going to want headlines. They're going to want to make gestures to their bases. They're going to want a piece of the spotlight. So those factors all wrapped into a period like we see in August and early September, which is generally a thinner tape. And what I've noticed over the years is the combination of a headline minefield plus a thinner tape, people actually start to game that. So you'll have larger participants in the market who know it's a little bit easier to push the market around here and there. And they know that people are going to have to respect any sudden burst of orders, because it could be the start of a reaction to some new headline that's going to change everything. So you get that combination, people start to game that combination. And as a trader, you have to respect those sudden sharp bursts one way or the other. And it's easier for people to basically generate those. And you have to respect them, because it could be a headline that changes everything. You can't double down on your position into it or whatever. Like you really have to be a little bit lighter, and you have to respect it. But when you're put in that situation, here's the big point: that removes your ability to have conviction. If you start feeling like that, there's no way that you can have the type of conviction that you need to have to actually trade well. And you get susceptible to shakeouts, undisciplined decision making, undisciplined trade management, impulsive activity. And all of those things are going to lead to losses, no matter how right you are about entries and market analysis. When you get into that mindset, it's pretty much impossible to win. So I'm really saying all this to just be on the lookout for that happening inside of your head as we go through a period where we've got a thinner tape and we've got probably what's kind of warming up toward being a political headline minefield kind of market, especially, after one earnings season, well before the next. The market's going to be looking for things to drive it. People are going to be gaming this dynamic. So, either you're going to be handling this right and it doesn't really end up putting you on the wrong foot or in the wrong mindset, or, you're going to start to realize you're making some undisciplined decisions and you need to dial it back. So watch out for that. If we get into that kind of context, it's less than ideal for aggressive trading anyways. It's not a problem to take a break and wait till the context changes and then get aggressive again. It's better than to go through a period where you really start to unravel your year because you start to make impulsive and undisciplined decisions.
All right. There's one more thing I want to touch on, Brett. We were talking about crude oil kind of a bit over the last couple of strategy sessions, and I don't know that you've traded it a whole lot. Are you waiting for something in particular? Has the setup that you were looking for not played out? Is it still underway? What are your thoughts there in crude?
So I'm still bullish on crude over a multi-month time frame. I said last time we talked, I said I thought we had maybe a couple of months of consolidative activity ahead of us, and that would lead to a sharp increase in shorting. We would start to see the net long position in the commitment of traders report maybe get chopped all the way back to like 350,000. We're not there yet. I think we're building toward that. We've got this peak growth theory. We've got the Delta variant. We've got tapering. We've got all these reasons for people to start to bet on a top being in place in crude. And I want to see those bets pile up. And then, I want to look for a fall trade to the long side, probably a combination of oil futures. But USO is a perfectly good vehicle now because we have backwardation. So USO is actually going to outperform the futures. Something to think about. Could be maybe USO and XOP, because you want to get the, rather than the service providers, the catalyst here is people aren't doing enough to expand production, which means they're not spending that much on oil field services, but the people who have the oil in the ground will see their value raise as the price of oil goes up. So you got oil and backwardation. It matches up with maybe a USO and XOP kind of positioning implementation theme. But again, I want to see us to really chop down that net long position first.
All right, that's fair. I don't think that there's anything else on the agenda unless anybody wants to chime in really quick. I think that is probably it then. Well, gentlemen, it is August, so as far as themes go, we pretty much laid them out as best we could. Expect somewhat of a thin, maybe choppy, maybe sometimes we'll see some upticks in volatility. I think the driving home theme, though, is to be patient, trade somewhat small. If you don't have conviction, don't overdo it with the trading. And I think I speak for all the traders when I say that. So with that said, gentlemen, thank you as always for joining us for the strategy session. And if there are any follow-ups, feel free to use the feedback, the talk to us link, and see if you can get your question addressed specifically to one of our trading team. With that said, guys, thank you so much for joining today.
Thanks a lot, Jim.
Thanks.